Welcome to the State of Venture Capital by George Van Hogarten of the Venture Company. Web address venturecompany.com. In the State of Venture Capital, I want to focus primarily on the economics of venture capital, because the state of venture capital is not the same as the state of innovation. I will demonstrate that further. As an entrepreneur, having worked in Silicon Valley for over 17 years, I noticed a pattern of dysfunction of venture capital. So what I found is that venture capital is economically constricted. First, if you look at innovation itself, innovation is really infinite. Large innovations are created that are then followed up by small innovations. Small innovations continue and then are wiped out by large innovations again. But when you actually study the financial system, that is the arbitrage of innovation, you realize it's highly finite. And it's not only finite, but it's actually regressive to the underlying asset. So how can we expect venture capital to recover if the economic model of innovation and venture capital are fundamentally incompatible? And I'm going to demonstrate that in this presentation of the state of venture capital. That doesn't mean all is bad, because once you've made the analysis that the problems in venture capital are systemic and come from the economic incompatibility, it means you can change the way venture capital works. And thus, if you change how venture capital works and make it compatible with the economic system under which innovation operates, we have a bright future ahead of us. Now, on occasion, I get the question, who is this guy? And I think it stems from the audacity to challenge a financial system, to challenge the arbitrage of innovation. And there's a lot of powerful people with money that do not like to be challenged. But if you look at those who left accolades on my website, you can see that my viewpoints resonate. It is the foundational principle of entrepreneurial thinking that tells me, so why does venture capital work the way it works today? And these people are not the losers of the industry. They are the ones that work in the industry and have been successful in the industry and realize that what we're doing is not helping entrepreneurialism and innovation. And many large publications in the industry are realizing that as well. But be that as it may, you can make up your own decision. Who I am is not really that important, but what is important is that most of the analysis of the state of venture capital is derived from my 30 years experience in technology, of which I spent 17 years in Silicon Valley building early stage companies, running it as a CEO, producing returns, and having seen as a venture partner the inside of the kitchen of venture capital. These are opinions from a person who cares about the production of innovative value. I was raised in a small medieval town in Holland, and I was bored out of my skull until my brother at one point in time came home with an HP 41C. And I couldn't get my hands off that thing. It fundamentally changed my life. I knew at that point what I wanted to do, and that was to create innovation. So let's go into venture capital. Who really cares about venture capital? If you've actually spoken to all the players in the ecosystem of innovation, the limited partners, the venture capitalists, and the entrepreneurs, you realize that there's actually very few people that care about the economic system of venture capital. Most of us just want to make money quickly and get out when the easy going is gone. But economically, we have to worry about a renewable system of venture capital. If nobody cares about a renewable opportunity of venture capital, then the opportunities of innovation will start to dry up. Sometimes it looks like only 20 people care. And 20 is also about the number of venture capital firms that make any money monolithically in venture capital consistently for limited partners in the asset class. And that's a pretty astounding number given that we had 790 VCs about 10 years ago. But everybody really should care about venture capital, because if venture capital produces, it is actually able to generate 20% of GDP. And so we all should care. Now let's step back a little bit and look at the history of venture capital. Venture capital is the financial construct using private shares to invest in private companies was invented by Georges Doriot in 1946. And it took him a while to make the model work, with investors banging on his door waiting for the returns of this early stage investment construct. And until he ran into Digital Equipment Corporation 10 years later was the model of venture capital really secured. But it leaves an important lesson behind, and that is that you can't stare blind on the financial system that you create if you don't deploy the proper risk to the right type of company. And we're going to focus on that in the State of Venture Capital some more. The important lesson also is that technology is the asset class that can provide superior economics, especially nowadays, because you have low-cost manufacturing. Software is an intellectual arrangement of bits. And so the only cost associated with that is some intelligent people with a computer in a room, and that's the manufacturing cost to which you can reach the rest of the world. And how you reach the rest of the world is using zero-cost distribution over the internet. So what that does is it creates an economic advantage. What technology can do is drive a level playing field for all people on this planet. And that is a very exciting endeavor with lots of investment opportunities ahead. So over 60 years of venture capital investing, we've created quite a few successes. But to be honest, a lot of these successes have not used venture capital as the first money in. Even Facebook did not take in venture capital as its first money in. So we ought to question the role of venture capital as the stimulus for innovation. But even if you believe that venture capital has played an important role in the process of guiding these companies to success, you have to look at the output side of innovation. To contrast, today there's still about 1 billion people without access to fresh water. Now, 60 years of technology investing has led to 6.4 billion people without high-speed internet today and without the ability to run applications that can fundamentally improve their lives. And so, with all the hoopla in Silicon Valley, well, we have to realize that we're just at the starting point of technology innovation that can improve everyone's life. And so, what we have to realize is that both water and high-speed internet are the foundational ingredients that people need to live a happy and prosperous life. But what's even more important is that the internet is truly the foundation of a new and growing emerging meritocracy. That means if everybody is connected to the internet, a level playing field for all people on this planet will allow us to discover the merit of each individual. And since innovation is predicated on the discovery of unique and outlier merit, the widespread coverage of the internet is crucial in discovering the new innovative opportunities this world has to offer. What technologists have to realize is that the economy is way more important than technology. The economy drives the need for technology. Most successes in the technology business actually stem from the attachment to economic principles. Facebook is successful not because it created a desire to communicate. Facebook is successful because it attached to the need to communicate. So it's the economic behavior of people that drives the need for technology. And there's tons of opportunities for those types of approaches of innovation. So how we build technology innovation will really drive our economic competitiveness. We have to start building more intelligent, renewable, and accountable economic constructs that develop, discover, and promote technology innovation. We can't just rely on an old boys network that resembles the ultimate in investor socialism to find the outliers of innovation. So let's talk about venture mania, as I call it. I call it venture mania because the economic disparity is the same as what happened with tulips in Holland in the 1600s. Let's start with what is venture capital. Now there's many definitions floating around, and those definitions are as foggy as the fog in the San Francisco Bay Area. People think that when they just move to Silicon Valley, you absorb the entrepreneurial DNA and you can call yourself an entrepreneur. Or you can raise some money for a venture fund and you go sit on Sand Hill Road and suddenly you know what you're talking about. Or is venture capital just plain voodoo? So let's try and clear that up a little bit. From my perspective, innovation is really the art of making promises. And when you create a startup, the ultimate goal is to create social economic value that the startup can pursue. And once you do, the upside will be fantastic. You have to deliver to customer number one that you have a great proposition. And then in some way, shape, or form, that message has to transfer to other people to make sure that they also want to buy that product or service. But as a startup company, you don't just have to convince the public, you also have to convince investors. And those investors are similarly fragmented. In many cases, you need more than one investor today to bring a company to reach social economic value. The art of innovation and venture capital is not the art of making promises, but the art of keeping promises. And the promise ends with the delivery of value to the public. The public doesn't care how you arrived at that point, as long as the value that you created with that technology innovation is a value that they cannot live without. An investment construct that supports innovation shouldn't care that much about the development of what happens in the meantime either. So let's put a definition on venture capital that is perhaps a little bit more clear. I think we can all agree that venture capital is a financial system and arbitrage designed to deploy high risk, high yield from groundbreaking innovation. So let's dissect that definition a little bit and see how well we did. First, let's start with venture capital arbitrage. Now, if you study the relationships in venture capital to support innovation, you realize that there's actually three players in this ecosystem. So in essence, the limited partner with money interacts with the entrepreneur with ideas through an arbitrage called the venture capitalist. Most people do not realize that the venture capitalist is actually not the investor. The venture capitalist is the intermediary, is the derivative between the asset holders of innovation and the asset holder of money. To put that in a schematic, the innovation marketplace looks like this. Limited partners on the left, entrepreneurs on the right, with VC arbitrage in the middle. Limited partners provide money, entrepreneurs provide ideas, and that process is supported by capital calls and investments that end up in the early stage company, which then provides returns based on equity and liquidity transfer to the limited partner. Of course, in the middle, the VC makes money out of management fees and carry. This innovation marketplace describes how the relationship between entrepreneurs, venture capitalists, and limited partners is actually an economic marketplace. And economic marketplaces have to work in a certain fashion in order to produce returns. What this relationship suggests is that the most important players in the venture ecosystem are really the limited partners who have the commitment to provide money to the asset class, and entrepreneurs who want to participate in that marketplace because they have ideas worth monetizing. But we don't want to discredit the role of venture capitalists in this process, because as Einstein said, it is the theory which decides what can be observed. And that means that the role of a venture capitalist is an important one. The thesis of a venture capitalist decides what innovation it actually can detect. And so the role and the experience of a venture capitalist in doing so is crucial. But they remain service providers. We cannot just assume that the performance of the service provider is indicative of the potential of the underlying asset. Let's look at the financial system of venture capital in more detail. First, at the top of the financial food chain is a limited partner who invests using asset management in many asset classes, only one of which is venture capital. But venture capital is usually a single-digit percentage of the total assets under management. And that means that the success of venture capital is really quite irrelevant to the total size of the assets under management. And what's surprising to discover is that many limited partners know very little about what's going on in each of these asset classes. They have deployed pancake economics, wide in circumference, very shallow in depth. Why do limited partners know so little about the actual deployment of vertical risk in their asset class? If you actually look at the flow of money within each of these asset classes, you discover something very interesting. First, an LP diversifies in alternative assets. That's the picture we just saw, the horizontal diversification, where alternative assets are usually the investments in private companies or emerging markets, etc. It's usually a grab basket of things that don't fit in other asset classes. Then it is diversified through direct and fund-of-funds investments. Diversification number 3 is the actual focus of that investment strategy in venture, private equity, buyout, or hedge. Diversification number 4 is the investments in multiple VC firms. Most limited partners have commitments to more than one VC firm. Then we have diversification in multiple funds. A VC firm has multiple funds that it manages, sometimes but not always, with the same general partners. So step number 6 is the investment in the diversification of risk to multiple general partners. Step number 7 is the diversification in many investable companies. Then that money is diversified into multiple rounds of funding, Series A, Series B, you name it. Then that money is syndicated with multiple peers in the industry. As Tim Draper once said, I'd rather syndicate than compete. And then diversification number 10, we split the investment up in multiple performance tranches that companies need to meet in order to get access to the full round of funding raised. Now what this means economically is that there is a total lack of accountability to the investment thesis. What this also describes is fear. If I know how to create social economic value, then why do I need to deploy 10 levels of bottom-heavy diversification? So this is an indication of what venture capital has become, the avoidance of risk rather than the deployment of risk. Now that picture actually gets worse. And if you look at the physical relationship between all the players in the ecosystem, then it's going to be hard to figure out what the critical path is. But even worse, it promotes investor socialism. And investor socialism is the opposite you need to create outlier performance. Now we see large investment networks mitigating the risk in venture capital even more, or the investment in pipes to compensate for venture capital performance. And who is really responsible? How do we really define early stage? And what venture capital firm actually invests early stage? Now, entrepreneurs are getting very frustrated about the behavior and the workings of venture capital. And these are not the losers of the industry. These are the people that have other options. So let's talk about high risk as part of the definition of venture capital. Venture capitalists for the last 10 years have been promoting capital efficiency as the unique investment thesis in technology companies. And still today, it costs about $25 million to build a startup company that can produce any meaningful social economic value and produce viable limited partner returns. During the period that venture capitalists have preached about capital efficiency as a unique investment thesis in innovation, the returns have actually been negative on the whole. So the successes in Silicon Valley have proven that capital efficiency as a unique investment thesis to venture capital is a lie. Now the Money Tree reports publishes statistics on the investment rounds into companies and the valuations associated with them. And to many financiers, numbers are the holy grail. But in this case, not everything that can be counted on. And let me show you that in a chart that Vino Khosla created some 7 years back. And in it he describes the infusion of money into early stage companies at what point in time. What you see here is that in the original methodology of venture capital, seed capital would go in when the idea is born, when the social economic value of that company is defined. When the idea is thought to be feasible, R&D capital would go in to support the creation of technology. Then go-to-market capital would be applied by a venture capitalist when the technology works. And when a customer buys, expansion capital would go into that company to support further growth. As the company progresses through these milestones, the valuation of the company increases. And at the same time, the risk associated with investing decreases. What's interesting to see what happened is that over the years, the definition of venture capital has changed. Notice that about the same amount of money may go into those startup companies, but they're applied to a different type of risk. In fact, most of the risk is actually deferred to the entrepreneur, meaning the number one question an investor will ask is, what have you built? And the reality is that technology risk is the least of the risk of the success of a technology company. So the investment stage has actually shifted. Seed capital now goes in when technology works. And then perhaps the same amount of money would follow, but in different stages of the evolution of the company. And what that means is that we actually apply less risk to those companies, which then yields lower valuations on the flip side. And the potential to producing outlier venture capital returns have diminished. Venture capital has turned predominantly subprime. Put differently, the deployment of risk in venture capital is fundamentally flawed. So the downside of a company is the creation of technology, so the upside of the company is yielding social economic value. If you look at how most Silicon Valley investors support innovation today, you'll notice that they actually deploy a uniform funding trajectory that usually consists of a 250K seed round, then $1 million A, maybe a B of 5 million, and it can still amount to $20 million. But what is wrong with it is that the starting point is associated with downside risk. That all the money that goes in is correlated to how much a venture capitalist will lose if that milestone is not being met. And so we throw 250K at a company, then force it to step up in a uniform fashion like most other technology companies in Silicon Valley. And then we hope at some point in time it will reach M&A or IPO opportunity. Forget about social economic value. Who cares? And this obviously is the wrong process of supporting innovation. For one, you cannot support outlier innovation with a uniform investment strategy. Using a focus on the trajectory rather than the focus on the outcome. Every company is unique, and therefore every company's funding trajectory will be unique. What investors should do is focus on the creation of social economic value and start with the agreement on social economic value and then discount or trace back to what is the best way to yield that social economic value. The composition of the funding trajectory should be specific to the creation of social economic value. Now, let's look at the trending model in venture capital more closely. And I charted out the standard deviation of risk versus the amount of money going into the sector. In the 1980s, venture capital just got started, and there were just a few firms that basically invested in a non-uniform fashion because the venture capitalists were actually the technology experts themselves. They had an expertise in hard drives or mini computers and used that expertise to invest close to their knitting. They created some fantastic companies and that yielded an additional interest from limited partners in the asset class. But at that point in time, some trending started to occur as to what a viable investment thesis in venture capital ought to be. And that exploded even further when the returns were produced and many other limited partners joined the asset class looking for the same venture style returns that were produced in the 1990s. In 2000, the bubble burst, and by the way, this is not the bubble of innovation, but the bubble of venture capital commoditization burst. And that yielded a reduction of money going into the sector, as well as a flattening out of the standard deviation of risk. Now, what we should learn from this evolution is that the outliers of innovation are actually on the fringes of the standard deviation. No amount of money can make up for the uniform deployment of risk. And so that's why I wrote on my blog that endeavors like Startup America or the hundreds of other programs to promote innovation that pursues the same uniform deployment of risk are doomed to fail. In 2020, we expect this to further implode and the opportunity for groundbreaking innovation to diminish even further. Now, this is a pretty serious chart because what it means is the amount of money going into the sector is not in correlation with the opportunity to produce outliers of innovation. And so venture capital really becomes a mediocre financial system to support the needs of innovation. Now let's cover high yield in venture capital. Let's go back to the innovation marketplace we described earlier and look at how we define success in venture capital. Now, the easiest way to define success is look at fund returns from venture capitalists. But really, that's a portfolio return, and it doesn't say anything about how many outliers were needed to produce viable returns to investors. But let's take it for what it is and use that as a derivative of the performance of innovation. Then, of course, there is the asset managers, the limited partners, who look at IRRs, internal rate of returns. Well, that by itself is an awkward measurement of success. The returns of asset managers are padded by the returns of other asset classes. But the most important indicator of success is really what the public thinks of it. And if the public doesn't have a 360-degree level of trust with the support for innovation, the whole marketplace falls apart. Because at the end of the day, the public deploys the monetary reserves to support the requirements of limited partners. The public buys entrepreneurial products or services that make entrepreneurs successful. And when all goes well, the public is asked to buy shares through an IPO or secondary offering to produce return on investments that make them want to re-up their efforts in the asset class. So trust by the public is the only real criteria to support a renewable investment climate for venture capital. But if we take each of these metrics of success apart, then we see why venture capital is in a heap of problems. First, the 10-year trailing returns of venture capital as the third metric is really quite mediocre and was negative for a long time and has now recently, last year, moved to 2.6%. Now that means that the majority of limited partners are actually barely making money. And I would argue that the change from minus 4.6% to 2.6% is actually because of the attrition of confidence in the asset class, meaning the reduction of the size of venture capital may make it more profitable for limited partners. But what it does at the same time is reduce the opportunity to yield groundbreaking innovation at scale. What's even more astounding is that while venture capitalists are proud that it actually produces positive returns, the consumer adoption rate in the worst of economic circumstances during the same period that VCs produced negative 4.6% returns was actually 7%. So if you do nothing but be moderately successful in the consumer space with technology, you ought to be producing around 7% returns. Apple, during the same period, produced 400% returns. Now, we could all say, well, that's because of Steve Jobs and he was a unique person. What it actually proved that if you create products that the market cares about, the market, despite the state of the economy, will actually absorb those products. So the market has proven that the products that are produced by the innovation that venture capitalists have selected just don't carry enough social economic value for them to buy into. Metric number 2 is limited partner confidence. And what you see there is that limited partners are actually diminishing their commitments to the asset class. And what's even more astounding is that some 80% of all capital committed to venture capital in 2011 went to just 7 large funds. So the commitment from limited partners is not only diminishing, but is narrowing to only a few funds that actually produce returns. The support from limited partners in the sector is actually diminishing because venture capitalists cannot capitalize on the opportunity of that innovation to reach social economic value that the public cares about. The ultimate metric is public confidence, and what we see is that the venture style IPOs have severely depressed. So what the market is telling us that it doesn't care about technology for technology's sake. It cares about technology that fundamentally changes their lives, that they can use on a daily basis. And as a result, because of the success and the economic advantage that it generates, they want to invest in that technology as well. And if you were investing in IPO stock, then you notice that the last 2-year post-IPO performance is minus 30%. The public sees no value in the majority of the IPO stock that we're pushing through the funnel. To sum it all up, massive amounts of money going into the asset class with more highly skilled people and more market opportunity has yielded actually mediocre venture capital performance. So the conclusion is that not venture capital is doomed, but the way we deploy venture capital is doomed. Not the concept of venture capital is broken, but the implementation of venture capital is fundamentally and economically incompatible with the needs of groundbreaking innovation. So if we want our economy to grow again, if we want to contribute to at least 20% of GDP, we have to improve the way we support innovation. And that means that we have to deliver an economic system that can fundamentally lead to the discovery of outlier assets. And that means that if the opportunity for innovation is infinite, then the economic construct that supports innovation has to be infinite and renewable. Let's not keep doing the same thing over and over again and expect a different result. To limited partners, I would say, why do you expect to generate outlier asset class returns from 10 levels of bottom-heavy diversification? To a venture capitalist, I would say, why really do you expect to produce prime returns from the deployment of subprime risk? As an entrepreneur, you should ask yourself, why do you submit to a marketplace of innovation in which only your vision and merit is challenged? Feel free to contact me at venturecompany.com/contact, especially for those who I've never emailed with, or call me directly at 646-580-0740. Thanks for your attention, and I look forward to improving the opportunity for innovation soon.